Will the real estate market crumble like Australia and Sweden? It seems like we're starting to see the fallout of something big. Warren Buffett, who's super rich and knows a lot about investing, is warning us about a huge problem in the US real estate market. Does it also mean we're entering a recession worse than 2008? He's comparing it to a massive storm that's about to hit. This storm is caused by a whopping $1.4 trillion in debt that people have taken on to buy properties. It's already starting to mess things up in the real estate world. But what we're seeing now is just the tip of the iceberg. Buffett thinks things are going to get a whole lot worse in a few months. A guy named Tom Seymour asked him about it, mentioning another person named Charlie Munger who also talked about this storm in the commercial property market. Munger says American banks are in trouble because they lent money for properties that aren't worth as much anymore. Now, people want to know how bad it's going to get and which areas will be hit the hardest. In the past 15 years, the real estate market in the US got a big boost from getting lots of money through loans. It basically stayed at zero for most of those 15 years. Because interest rates were so low, people borrowed a ton of money, which made real estate prices shoot up really high. Imagine someone wants to buy an office building in your town and it costs a cool $1 million. Now, most folks don't have $1 million just lying around to buy a building outright. So what do? They head to a bank to borrow most of the money. Say the buyer puts down $350,000 of their own money, which is called equity. That's like the deposit you put down when buying a house. Then they go to a local bank and borrow the rest, which is $650,000. In our scenario, let's say the office building pulls in $60,000 a year. Looks like it's making enough to cover that payment without breaking a sweat. Think of it like this. The debt service coverage ratio tells us how much breathing space a property has to pay its debt, especially if things go south. To figure it out, we take the property's income, which in our case is $60,000, and divide it by the yearly debt payment, which is $32,500. That gives us a DSCR of 1.85 times. Now the thing is, banks usually want to see a DSCR of more than 1.2 times. So with our property's DSCR of 1.85 times, it's in a great shape and passes that test with flying colors. But let's see what happens when interest rates go up in the US. Usually, when people buy a house to live in, they get a 30-year fixed rate mortgage. With this type of loan, the interest rate stays the same for the whole time you're paying it off. This makes it less risky for the buyers because they don't have to stress about their monthly payment shooting up if the interest rate goes higher. Interest rates on commercial loans don't stay the same for the whole loan period. Instead, the loan comes up for renewal every 3 to 5 years, and the interest rate changes to whatever the current rate is at that time. Let's crank up the interest rate even more, up to 9%. Now, the debt payment on the building shoots up to $58,500. The income of $60,000 barely covered this huge payment. But hold on, this building is an office space, and with more people working from home, there's less demand for office space. So let's say the income drops from $60,000 to $40,000 because 10 tenants don't renew their leases, leaving more empty offices. Now, the owner is in real trouble. The property doesn't make enough money to cover the debt payment. That means the owner might lose the building to the bank, who will then sell it for way less than it was bought for. This is exactly what Buffett meant when he said, "The buildings stick around, but the owners might not." Buffett explains how we got into this real estate mess. Lots of folks dive into real estate without putting much of their own money at risk using something called non-recourse loans. Once, Buffett was talking with Charlie and a real estate expert, and he asked, how do they decide a building's value? Charlie said it's basically whatever they can borrow without guaranteeing it themselves. Many big real estate players think the same way, but when things go wrong, it's the lenders who end up stuck with the property, and they're not thrilled about it. So the real estate folks scramble to work things out with the banks. But here's the deal. All of this has consequences, and now we're seeing the fallout. People who got loans at really low rates are struggling with today's rates and giving the property back to the lenders. When you take out a loan to buy a house to live in, you have to sign something called a personal guarantee. Basically, this means that you're responsible for paying back the bank no matter what happens to the house. So let's say you have a $400,000 mortgage, but the house's value drops to $300,000, you're still responsible for the full amount of the loan. You can't just hand over the keys and walk away. Because of this personal guarantee, the bank will make you pay the difference, or you might have to declare bankruptcy. Let's say a big real estate company buys a property for $50 million. They put in $10 million of their own money and borrow the rest, $40 million, from a bank as non-recourse debt. Fast forward a few years and it's time for the loan's interest rate to change. The property's value dropped to $30 million. Since it is a non-recourse loan, the owner can just give the property back to the bank and walk away. Sure, the real estate company loses the $10 million they put in, but now the bank's stuck with a property worth less than the loan. And because of the non-recourse deal, the bank can't do much but accept the loss. But here's the problem. Many of these properties aren't worth as much as they used to be, or they can't handle the higher loan payments because of the rising interest rates. What does that mean? Well, a bunch of these properties might end up in the foreclosure soon. It's already happening. Look at Starwood, a big real estate company. They recently couldn't pay back a $212 million loan for an office building in Atlanta. This building used to be a top spot in a big growing city. Only 60% of the offices are filled, way down from 90% when they got the loan in 2018. The building lost so much value that Starwood didn't even try to work things out with the lender. They just gave back the keys and walked away. When the real estate storm hits, it's not just gonna be the big Wall Street banks taking the biggest hit. Nope. It's gonna be the smaller banks that gave out most of the loans for commercial real estate. Now, don't panic and yank all your money out of those banks if you're with one. Most of them should be able to handle the losses just fine. And even if some do go under, your deposits are protected by FDIC insurance. But these smaller banks aren't just into real estate loans. They're also big on banking for small and medium-sized businesses. But as Charlie Munger, Buffett's sidekick, mentioned earlier, there's some tough times ahead. The big question is, who's gonna feel it the most? So that's the scoop. Don't forget to subscribe for more insights, because we're here to help you become a smarter investor by learning from the best. Catch you later.